very easy as a trader or investor to get caught in a very simple trap, but a very nasty one. People buy because they're excited. They see the price going up, they say, I've got to get in. And typically they get in around the exhaustion area of a move. Now, why does this happen? Because people need certainty. They need to feel certain that it's going to go up. CTKS traders understand maximum certainty equals maximum risk. That's rule 887. This is a really important concept to understand. When the markets go green like this, and just pretend you can't see any of this price action across there. So the markets are printing higher and higher and higher. Everybody's talking about banana zones and exponential price action and blow off tops. People are really very certain that everything is going to go fantastically. And then what happens? Well, that's not good. And this is certainly not good. Nobody would be prepared for that. Well, we are, but other people wouldn't be. Now, why would we be? Because we always plan from 3 dimensions. We know price is always moving up and down. If you're in something that is moving up and down by nature, you have to have that up and down theory as the basis of how you look at price. We plan out in 3 dimensions: up, neutral, and down. Now, the trap that people get caught in, they buy because they're excited, they hold because they're hopeful, and they sell because they're scared. Now, all of this happens around certainty. People buy around certainty. It has to go up for a period of time for people to feel, oh, okay, it's good, it's good. Now, if you just recently got into gold, you'll know that it just retraced quite harshly. That was certainty playing out. You probably thought, oh, I can't lose. When you say I can't lose, you're going to. Any profits you make will be temporary. So the concept of this particular video is don't give it back. So many people buy on green and sell on red. And selling on red makes sense because they're certain that it will go down. There's that word again, certain. There are 4 stages that every trader and investor progresses through to become consistently profitable. Zone 1 and 2 are the certainty zones. Certainty is something that you're taught in the non-financial world. You have to be certain how much pay you're getting. You have to be certain how much time you're spending. You have to be certain that relationship will work out. Unfortunately, life is just not like that. We can't be certain of just about anything. And when we're not certain, when reality bumps up against us, what do? First of all, when things don't go our way, we panic. And then what do? Well, we're not going to blame ourselves. We're going to put the blame outside of ourselves. This is all completely natural and completely normal inside financial markets. Unfortunately, when we're in Zone 1 and Zone 2, the only certainty is that we'll lose money. Everybody starts here, so if you're feeling these things, don't worry about it at all. You can progress outside these zones, from Zone 1 into Zone 2 into Zone 3. The only way to get there is through learning, and you learn that certainty just causes you terror. It's like a match factory that needs to be certain that every single match works. There's only one way to do that. That is to light every single match, and that is not a good way to sell a product. I'll just explain how it could work in practice using that box of matches example. Here's your box of matches, and you've seen price come down, and remember, you can't see towards the right side of the candle. So you see it coming down and down. Oh my God, it's over. 1929 crash, GFC, it's all over. It's C19 all over again. And then what does price do? Well, by this time, most people inside Zone 1 have turned off the TV, shut down their computer, destroyed their desk, done all sorts of things because they've actually sold here on red. And they just walk away, and then they see prices coming up. Well, they're not going to get in here. It could go down. What about here? Oh no, not really. The box of matches comes out right up here because they're feeling more and more certain the price will go up. And here the match gets lit and the trade gets done, the investment gets pulled. There, fantastic, I bought. Probably right there. Now what happens next? Hang on a second. I knew this thing would come down. But it's going to go up. Oh no, it is going to be okay. It's going to reverse. It's hitting structural support because structure is just like that candle or something. And people, this is the problem, that people don't investigate their charts and don't investigate intercorrelation, interconnection. They have literally no idea why the market works the way it does. And then we see a horrendous sell down and people will hold, and then they will sell just about here because they feel certain that it's just going to keep on going down. And they're right. Look at this. It went down. So what are we going to do now? Well, we won't touch this stuff. It could go down again. But what is actually the truth of price action? Can you make money when price goes down? Just going long at spot. Just long at spot just means that you buy it and you hold on to it. You can go long under leverage, but unless you know what you're doing, you're going to get badly burned by price. And of course, if you want certainty and you're going and using leverage, if you're just lighting matches around the top or around the bottom, that's a terrible thing to do because you will destroy your account. And just think about it like this. If you're buying up here and selling down here, and then buying here and selling here and doing that repeatedly, what you're going to do is just cut your account into shreds. There's a much better way of doing everything, and it is the way of the CTKS trader. One thing to realize, that rule 138, all investors become traders every time they buy or sell. That means it doesn't matter how the tax department looks at you or how you look at yourself. You are buying at a certain time and you're selling at a certain time. Now, most people buy when it's green and sell when it's red. And the only thing that comes from that are losses, unfortunately. Traders think completely differently. They know the price moves in a wave. Traders have to be very specific about getting in and out of the market. You want to become an investor who knows how to trade. The CTKS method is all about reversing this green candle problem and reversing the red candle problems. We know that we get certainty after price starts to print in one direction, either to the upside or to the downside. And typically at a point of maximum certainty, that is the point of maximum penalty to the market. Now, how do we combat this? This green fire is very seductive. It's it's empowering stuff. If you buy on green and the price goes up, you feel like a superhero until the red naturally comes. And these wipeout triangles are just part and parcel of markets. You can see that just about literally every single green fire, and green fire is all these institutional god candles that get printed, they're all basically retraced to the base. Now, when you think about this, you're starting to understand how markets work. Traders understand how markets work. Investors think, it doesn't matter. I'll just get in here and I'll just hold it for the next X number of years because something to do with tax. You don't want to be thinking about tax. You want to be thinking about profits. You want to focus on not getting in here and here, but around here, around there. You get the idea. If you're getting in here and here instead of these places, you're going to do really, really well. You must lower your average buy price. As either a trader or investor, it makes no difference, but you must lower it. The only way to do that is to apply a very famous community rule. That rule is Rule 621, buy on red, sell on green. This is the opposite of certainty. On the opposite, absolutely. Sell on green? Why the heck would you do that? Wouldn't you buy? It's certainly going up. And what about buying on red? What kind of nutcase would buy on red? That's like, what did the institutions tell you? Don't buy a falling knife. Why? Because they are. But Ken, everybody buys on red and they sell on green. Hang on a second, what's going on here? What's this little cartoon about? Well, it's basically saying when the price goes up, everybody's happy. When the price comes down, everybody scatters. When it goes up again, and when it comes down, nobody to be seen. This is the opposite of what we do. To understand, buy on red, which is BOR, and sell on green, which is SOG, and together they're BORSOG. The day you plant a seed is not the day you reap the harvest. Please let me know in the comments, how many times do you buy on green and then sell on red instead of doing it the other way? Now, what I'm showing here is just a bit of a snapshot. Well, this is actually a live chart of trading Bitcoin. Now you can see my greens. I'm structurally buying here, so I'm using level 1 and level 2 standard certification to guide where I come into the market and buy. I'm also using those standards, the same standards, to tell me when I should get out. From time to time, I'll put test positions into the market to determine if price is going to get above a certain level of structure, and this is that 111,300 level that we knew was an absolute doozy. So as price was coming into that, I sold positions, and I'll show you what those positions were just in a tick. But the idea is that I was buying all the way down here. Now you can rotate out of positions, which is a good idea. So you can take some positions from a higher level and then just buy backwards and down. But when you do this, you might find that you don't get an opportunity to buy down. Maybe the price just decides to just go for it. And if that's the case, you need to be flexible. For example, I bought here just recently, I bought here as well. I saw that the market was not doing what I wanted it to do, so I sold down and spread my account out as price was coming down. Now, what does this mean? This is really important because if I buy up there, you can see those prices are underwater compared to where the actual price is now. Now, this is all live stuff. I'm not cherry picking. I'm not saying here's a good part of the price action. I'll just show you that. I don't do things like that. I don't think that is a thing of integrity. So I'll just show you what I actually did. So what you can see here is I rotate out. Now, I kept the loss very small. Do I have a specific loss target that I use? Absolutely not. I just look at the structure, I look at intercorrelation, I say, is this thing going to go for it or not? If the answer is, I don't think it's going to go for it because intercorrelation and interconnection and structure tell me a story that it's like it's weakening, it's going to get weaker, I will pop out. But that means I can also pop back in again at any time. So many people just say, oh, I have to be right. Why do you have to be right? You need to be profitable. Don't worry about being right. When you get this damn thing moving in a wave, it's very hard to be right. You just have to protect yourself. Now this is about don't give it back. And we don't give it back in two ways. One, we protect our capital. And you can see this is a live chart. These are actual trades, not cherry picking. I'm showing you what's happening. Now, one thing about don't give it back is don't take a loss greater than you should. Now, what's greater than you should? If you're hoping and praying, that's a really bad strategy because hope and pray have nothing to do with market action. Now, you'll notice here that I've started to buy again. Now, why is that? Because this 111,300 mark was flipped by this particular price action. It came down pretty harshly, but we know from our rules that sharp angles reverse or reflect. If they reflect like this is pretty normal, and we could get a substantiation of structural support here. We already know that this was the very early days of price doing a repair. So what I did, I bought down here, I was buying, and I sold up here. I did a couple of test positions in here as well, like I did test positions in here also. But the key is, keep your losses really, really small. Recycle back into market wherever possible. Now, one of our beloved community members reached back and said, Ken, I keep on running out of dry powder. Now, what the hell is dry powder? That's cash. Now, when you run out of cash, you're concentrating too close to price action. You should be able to concentrate way down if you wish. Now, why should we do that? Shouldn't we just go all in and more and limit our loss to less than 2% of our account? Well, when you do the CTKS method, you're buying from a structural perspective like a brilliant long-term investor. You're planting all the seeds in here, you're rotating out of positions, buying them back, you're making sure that you're always keeping your loss really tight, really small. And the profiting students from the masterclass already know, you can see a little cell there, you already know why I did that. You must be very disciplined. Now, if I just scroll down a little bit, you can see that I have a standard position size 1p, which is 10,000. This cell, remember those cells up there, that was 7.14%. Now this is on Bitcoin, which is not a bad percentage for that, but you can only get it when it goes down and rebounds. So that's why we BORSOG. So 700, this is US dollars. 548, 507, 404. This was a 12,675 profit. And you can see here, that was around a $500 loss. That was a sell that I made up there. This is all part of not giving it back. As soon as I understood that the market looked a little bit weak, I exited this position. If you look at that as a percentage of a 15p position, it's literally nothing. So you can see here that these positions were sold there. That's that 150,000. And these are the other ones. So when I'm coming in and out of the market, I'm not doing it with $100 or $1,000. It's a reasonable level. Remember, inside the markets, only knowledge profits. If this position had allowed to run down, that could have been a very nasty loss. You must always bear in your mind, don't give it back. Don't give it back. Make sure that you plant the seeds. But if you're planting the seed near the top of the harvest, that's not a good idea. You need to be really cautious around these areas. And that's what I am. I really respect the market. And something else that could really help you out. When markets go particularly red, translating your funds into Bitcoin away from the alts is not a bad idea. Of course, it comes down to your position, what you want to do. But what we've seen with the crypto market is there's so many crypto projects. There's literally over 23 million cryptos. They're all out there begging for funds. Give me your money. I'm a crypto project. But the institutions go, no thank you. I'm going to take the top ones. Now, what does that mean? It means that the flow of funds, especially a considerable flow of funds, goes into major market cryptos. They have the potential to pop, whereas sub-projects have the potential to bleed. Now, another thing, you don't have to go into the market and just trade every up and down spike that exists. You don't have to do that. It depends on what you're doing. You can be actually quite passive. I passively put the levels into the market at structure. I always buy structurally. And if I don't buy at structure, I know exactly where it is. And you can see from the amounts that I put into the market, if I don't know where the structure is, I just couldn't do this. It would be gambling. Having been inside financial markets for nearly 4 decades and coming from a financial background, a finance degree, I know that I have to look at the cheat sheet every single day. I have to understand what's happening from row 1 all the way down to row 7. I'm not going to put any money into the market without a knowledge of this. I have to know where the structure is. I need to know where the safety nets and where the ceilings are inside price action. I need to know the monthly structural model. And the monthly structural model is actually 1,000 times more important than the long view models. A lot of people say, show us the long view model. Well, I could, but the concept is if the monthly models are failing, the long view model just doesn't do anything. You need to know what's going on inside the market. That is critical. And you actually get month-on-month visibility. Now, why is this important? Because if you can see what the market is doing on a month-by-month basis, you have your 3 paths in process. Now, just remember, I've been making money as the markets come down. I've been going long at spot, doing things that others say are impossible. People have actually reached out in the comments and said, you can't make money going long at spot in a negative market. I hope I've shown you, you can. But you need to know what you're doing. You need to be able to time the markets. A lot of people say, you can't time the markets. Of course you can time the markets. It's just that they don't know how to. And it can take decades to learn how to do that. Now, when looking at Bitcoin, because Bitcoin is the arbiter of risk on or risk off across all financial markets, what am I looking at? What is my opinion on where Bitcoin is going? I can see Bitcoin has done a first level cut. This is it's very profitable, and we already knew that potential existed a couple of days ago. It was very early, and you can see that I just don't talk about it, I do it. I'm actually in the market trading, and not just on Bitcoin. Right now, there's an upward supportive bias inside the crypto market. Now, these particular tails, you can see the up and down. Yesterday, it was all the way down there before it rallied, and then it came back. But I was buying with abandon. You can see that from the price chart that I showed you. Just zooming into Bitcoin for a little while, we can see this 111,300 level. Now, this is called an SZ, or Stanfield Zone. You remember I made a sale. I made a sale when we were starting to get structural rejections here. Now, when we get structural rejections, we got immediate structural targeting into lower levels. So I redistributed funds across these areas. And for example, from a momentum perspective, I was pretty sure because of intercorrelation and interconnection that we were going to get a pretty substantial bounce. But after a retracement and then a bounce, I mentioned that in yesterday's video. Now, the issue here, I'm not a person who has $50 in the account and I'm just putting $50 in and I'm praying that it goes up. It's not like anything like that. And I've seen plenty of YouTube influencers who talk about trading and they've got no money to rub together at all. I just don't get it. But the issue is, as soon as this was weakening, I sold the position and then layered back in terms of structure. Now, we know, especially the elite service members know, around that 109,000 is very, very strong structure. I've been layering back into that area, hoping that will get hit. Now, what if it keeps on going? What if all of this triangulates itself and wipes itself out? Well, there's no certainty inside any financial market, and there doesn't need to be. Certainty is like this. I'm certain that it's going to go up. Oh, okay, it's proven itself. I'm going to get in right here, and then it does that. And then people start revenge trading. They say, I have to be right, so I'm going to buy as much as humanly possible to turn this thing around so it goes past that, and then I can sell. I can get out. We don't do those things. Revenge trading is too expensive. Remember, up here I was layering in and I got rid of that level. You have to be able to do things like that as well. If it's not going in the right direction, if it doesn't have the kind of momentum that you would anticipate it would have, just get out, reset, go again. Now let's just zoom into current price and I'll tell you why I have a degree of confidence structurally. As far as structure, you can't tell any structure from here. That's why I mark up my charts with level 1 and level 2 standard certification. We can see around this 111,300 mark, there's a GW, a gravitational well. So I would anticipate it gets caught here and at least gets above that. If it doesn't, I'll make a decision based on that information. But what we're looking at is literally some positive price momentum above that 111,550 level. If we don't get that, we can target lower levels. Remember, you're like a farmer, you're planting seeds, but you're doing it in fertile ground, not on rocks. There is an entire philosophy that underpins the CTKS method. We have our level 1 and level 2 standards that allow us to just put in the world's most powerful structural indicators. And this is absolutely vital. Without understanding where support and resistance levels are, where the floors and the ceilings are, and without the capability to buy panic and to sell greed, we'll always be wrong-footed. Without three-dimensional thinking, we'll think that things are going in our way when they're going the opposite way. And we'll hope and pray. Hope and pray causes losses. Inside financial markets, in the real world, they're beautiful things. And it's vitally important to look across the intercorrelation of markets. We've seen in the past 24 hours, gold has been hit on the head, as has silver. A lot of people said that they couldn't figure out why gold has gone parabolic. Certainly nobody predicted the move. Nobody predicted the move that crypto could come down, and nobody predicted the move that gold and silver would go parabolic. Elite Service members know that at the start of every month we draw up paths based on CTKS structure for price across all of the cheat sheet components. And here we can see gold. Gold did a big hell candle down, and what has it actually done? It's just coming back to the normalized positive price path. We see this all the time. In last month's price action, we pretty much pinged the upper boundary of gold, and gold was moving with positive structure. It was overcoming structure and doing well. And we've seen an outperformance of structure, but we always anticipate that structure is so powerful it will be pulled back into it. And what about silver? We've seen a similar thing. The thing to understand, this is level 2 standard certification. So these paths are drawn to reflect what the structure is inside silver's price action under normalized price conditions. And we can see that last month they did a fairly good job of predicting where silver would go. A little bit of a positive push up at the end of the month. Now don't forget, these positive price paths and negative price paths are there for risk management. If it's going positive, it is not going negative, it is not going neutral. This is very important information for people to have. These are paths that are shared at the start of the month inside the service, and Elite Service members understand these paths, and it is explained through the monthly video. So we've literally come back smack bang on the positive normalized price path. And this is the difference between trading and investing. Investors just hope and pray that it's going to go up. Traders have a very different system. They look at price action, momentum, trend, all sorts of things, direction, intercorrelation. And then they just take it month by month by month. That is a professional investor. A lot of people say, investing is really just about I'll buy it and then come back to it sometime in the future, and I don't care about it. Those same investors watch the price every single day, maybe multiple times per day. If you can understand or relate to what I'm talking about, please let me know in the comments. That's pretty normal. Please let me know in the comments, which direction do you think the market will go in the next 24 hours? I would love for you to become part of our global family. All you need to do is smash that like button, subscribe, press the notification bell, and just drop a comment to say hi. Doing this shows that you are committed to forging a better life for yourself and the ones that you love. With financial literacy, you can become recession-proof. Trading is a lifelong profession. Tourists visit during bull markets only to get wiped out, but professionals stay no matter the market conditions because they know that buying lower is the secret to success. You will create security and financial freedom in direct proportion to your capability and willingness to learn. If you commit, your world will improve immediately. I hope you've enjoyed this video, and Kate and I very much look forward to joining you again in the next one. Take care, be kind to yourself, be kind to others, show gratitude and happiness, and you'll already feel richer today. And today is all we ever really have.